Let's do it. Well, good evening, everybody. Thanks for spending this time with us tonight. We're so glad to have you. Welcome to Family Wealth Partners' presentation of Don't Cheat Yourself, how to make the most of your 401k, IRA, and other investments. We host education events like this because we believe in education, because we believe that when someone understands what they're doing with their money and why, they're going to be more confident and more empowered to make better decisions with their finances as well as their investing. And we believe that how you invest matters. So our goal tonight is to provide you with more clarity on what investing really is, the ability to identify common myths of investing, and most importantly, we want to let you leave here with what is really important when you invest your money in your 401k, IRA, and really any investment. So for those who don't know who I am, I'm Leo Terrio. I'm a registered investment advisor with Family Wealth Partners. I have been with the firm now for 7 years. I came to it from the banking and higher education financing world. And I came through education and exposure to philosophy and concepts that you're going to get here in this class tonight. For those of you not familiar with Family Wealth Partners, we are a registered investment advisor firm here in the state of North Carolina. We've got an office in Concord. We also work out of the Packard Place offices in Uptown Charlotte. We are fee-based and a fiduciary firm, and we help our clients in all aspects of investing as well as financial planning. Our assistance is rooted in education, in academic research, as well as investing science. And you're going to see that throughout the presentation tonight. All right, let's get to Zoom housekeeping. As you have noticed, everybody is in auto mute at this time, and everybody so far is not on camera. That is optional. Just don't put in the chat what you're having for dinner, because you'll make me hungry. As far as mute goes, we're going to use the raise hand feature if you do have questions. So we do want you to engage. That is found in the participants area at the bottom, and we'll show you that in a minute. We are recording this so we can get out the recording to folks who weren't able to make it, and we can make it better the next time we do it. All right, let's take a look at the Zoom screen to get on the same page with that. At the top, you'll see the view options. You can use that to enlarge the presentation. Likewise, you can use the divider between the presentation and the presenter panel to enlarge or decrease either of those panels. And then you'll notice the arrow at the bottom will point to the participants area. When you click on that, that box will arise, and you'll see the raise hand feature on the right-hand side. When you click that, we'll ask you to come off mute and ask your question verbally. If you don't want to ask that question verbally, then please put it in the chat, and what we'll do is read it off and then allow folks to hear our response to that question. All right, last bit of housekeeping. You chose to be here tonight for an hour, so we ask you limit distractions, please take notes, and ask questions. All right, let's get on to Don't Cheat Yourself. So Keith Laibson is the founder and president of Family Wealth Partners. Keith holds a degree in finance, and he's been helping people make great financial decisions with their money, with their investing choices for almost 25 years. Keith is passionate about education like this tonight, and he's passionate about helping people with their finances so that they can use them to chase their dreams and goals for life. Without further delay, take it away, Keith.
Thank you, Leo. Thank you for that introduction. I appreciate it. And I also want to thank everybody for taking time out of their busy schedules to spend it here with us this evening. We know we all have a lot going on, so we do appreciate when you take a little bit of time out of your day and your evening to spend it with us. So thank you again for attending. And what I want to do is I want to acknowledge the different people are in this room tonight. Okay, and what I mean by that is the first group of people, there's 3 groups of people. The first group of people are the people who know us, Some of you are our clients, some of you are friends, some of you who just attend our classes. And so for you, this is a great foundation class. It gives you a lot of good information to build on that will tie into the education that you're already receiving and part of the discussions that we're already having. The second group of people, we call them the clean slates. You are beginners. You're really just entering the world of investing, and looking to learn. And so for you also, this is a great foundation class that will get your antennas up and get you start thinking about the things that you should be doing and the things that you probably shouldn't be doing. And then the third group of people, are the people that have experience, that have your ideas and preconceived notions of the ways that you should be investing and what you should be doing. And so what I would say to that third group of people, and this also applies to everybody, is that what we teach is thought-provoking and a little bit different than what you might already think and believe. So we just ask, you to have an open mind, sit back, relax, and enjoy and engage in the discussion. All right, fair enough? Excellent. So let's get started. There are 3 powerful things that everyone needs to know regarding their financial future and as it relates to investing. Number 1 is the mutual fund companies and the financial industry at large is gambling with your money, and you don't even know it. Number 2, most people think that they're diversified, and I can tell you at some level, the degree will vary, you are not. And the third one is this, and we already kind of know it, is that the media overwhelms and confuses us. So again, what we're gonna do with Don't Cheat Yourself is start helping you navigate through the fog and gain financial clarity. Excellent. So the first 3 powerful things I said was they are gambling with your money and you don't even know it. Now, when I say that, most people immediately think that I'm talking about the act itself of investing in the stock market, but I'm not. Now, we know this, or we all know this, or we should know this, that the stock market is where you go for your growth. That's where you get your growth that beats inflation, and that's where you go for, again, growth. But if you do it the right way, investing in the stock market really isn't the gambling that we're talking about. It's the other activities that we are taught and that we are led to believe is the way that you do it, either you or somebody else. And I'm going to get to these activities in a moment. There's 3 big ones. Do you have anybody who is courageous to venture a guess? Raise your hand or put in the chat what you think those activities are that either you or someone else engage in as your mechanism of way, things that you do when you're investing in the stock market? Any takers out there want to venture one? If you so, raise your hand. If not, we can I can give them to you. Give you the easy answer, easy way out. Okay. So when I show you, now you might know them and we're bashful and shy to say it, or you might not really got the question. But when I show you, you're going to do that. Oh yeah, now I know what he was getting at. Now it makes sense. The activities that we are taught, and we call them myths, but we're going to explain why in a second. There's 3 of them. Number 1 is this, stock picking. Number 2, market timing. And number 3, track record investing. So whether you realize it or not, we are taught and you are told that this is how you invest and get those returns in the stock market. You got a stock pick, you got a market time, you got a track record invest. And if not you, someone else is going to do it for you. And so we just take these activities as truth, but no one ever really looks at, is this fact or are these activities really a myth? So that's what we're going to do. And then at the end, we're going to cycle back and then eventually teach you all how to invest and have a positive investment experience. So let's start taking a look at these activities. Oops, excuse me. So, okay, that's right. Before I do that, what is a myth? All right. So a myth is a story that is made up to explain a phenomenon beyond the science of the day. So for an example, many years ago, before any of us were even on this earth, the people thought the earth was flat, right? So science of the day kind of moved along and they figured out that the earth actually was round, okay? And that one is true. I looked it up, I Google searched it, and the earth is round. So that was true. A more common example would be the tobacco industry. So there was actually a period of time where, smoking cigarettes was deemed not harmful at all. But as science of the day caught up, it became more evident that, oh, hey, it's a little bit harmful, and now we know that it's very harmful. Okay, so now we're going to do the same thing and look at those myths and see where's the evidence, or are these activities really, like we just said, a myth? So myth number one, stock picking. It's this, we're told that you can pick stocks or someone else can do it for you and pick stock that you believe will do well in the future. So first let's define stock picking and where does it happen? There's really three levels that we see people where you stock pick. So the first one is if you're someone in the room that does this, well, you know you're stock picking, right? So people, they'll pick stocks on their own. They'll do their research. They think, you know, XYZ stock is the best stock to buy for the future. So they'll buy stocks on their own and they might buy and hold it for a while, or some are day traders. But one way that stock picking occurs is yourself, you're doing it. The other way is some people will hire a broker or an advisor. I know advisors that are independent, even fee-based or commission-based, that will set up a custodial account for you, and you roll you give them your money, your IRA or other money, and they will stock pick for you, right? And try to, you know, pick the best stocks. The third way, and this is the most common way that people are stock picking. So a lot of times people will say, Keith, well, I don't stock pick, or yeah, my advisor doesn't either. So you know if you're in one or two, pretty easy. The third one is most people don't realize they're stock picking, and that is that most people are using actively managed mutual funds, right? So mutual funds are the most common investment vehicle people are utilizing. It's pooled assets where we give our money to a Fidelity or a T. Rowe Price or a Putnam or Oppenheimer, and the fund has an objective, and they pool all the money together, and there's a manager who is stock picking. Okay, that's the most common way that people are actually engaged in this activity. All right, and then you also have separate managed accounts for high net worth people and, you know, other kinds of stuff, but these are the most three common ways that we see it. So for the visual people, if you want to venture, we're going to cycle back down to this later and compare active stock picking to an index-based approach. But you can go on morningstar.com, put your fund in there, and then a screen pops up and there's a bunch of tabs, and one of them will be holdings or composition of that fund. And if you can't find this information on there, we'd love to help people to shoot us the name of your fund in an email or give us a call. But you'll start seeing, you know, you want to ask your fund people, what's your turnover rate? The turnover rate is the level of stock picking, right? So for an example, this mutual fund had 152 stocks, loved them so much that every 12 months, he turned over 81% of that portfolio. And you'll see here, some are over 100%, right? So this manager loved his 190 stocks so much, he turned it over 12 months, and out of the 190 more that he bought, he turned it over another 21%. So that's what stock picking looks like inside of these mutual funds or these active products. So what's the myth? The myth is that there's people that can consistently and predictably add value by engaging in this activity, whether it's yourself or somebody else. So now we're going to look at where's the evidence. Is the evidence there? And a lot of times, one funny thing with these classes is sometimes we do surveys and half the room will say too much detail and half the room says not enough detail. So we think we come to a good middle ground. So if you're one of those people who wants more detail, I've got it. We can spend 3 hours talking about this stuff. So sometimes if you don't get the concept, the details don't matter. But in this case, we'll kind of look at it conceptually and give you some of the details. So the myth is this, and how we're going to do this is thinking with the end in mind. We're going to look at that most common place that people engage in stock picking is that mutual fund world, where you have the professionals, right? Where you give them the money, they pool the assets. I just showed you where they're stock picking, and the goal they're trying to do is beat, you know, market returns or get better returns and so forth. And so one of the games that they play is what's called the law of large numbers. So what that means is this: if you have enough people doing the same exact thing, no matter what, there's always somebody who's ahead of the curve. Doesn't mean that'll be the same person every single cycle, but if you have enough people flipping a quarter, right, the odds are I won't get heads 10 times in a row. But if you have 20,000 people in a room all flipping a quarter, it's very likely somebody's going to flip heads 10 times in a row. Doesn't change your odds, So the industry uses this law of large numbers to perpetuate this myth that stock picking adds value. So let's kind of show that to you. As of 2019, just in the world of actively managed mutual funds, where these are the professionals, the people that do it for a living, in the history of this product, dating back to 1923, there's been 67,000, sorry, it's hard to draw a line. I know Leo's gonna yell at me again. 67,000 of these actively managed mutual funds born. As of 2019, there was 35,000 in the marketplace, which means historically, 32,000 of these products have been shut off, killed, and closed. If you look right here, total number of dead funds or closed funds, new funds being added. This is annually. What you'll notice, there's thousands of funds, 2,000, 1,600, 2,300 being closed off or killed every year, and new ones being added. Anybody want to venture a guess why a mutual fund gets closed or terminated? Okay. Oh, we got a raised hand. Excellent. Leo, you want to unmute that person, please?
Hello?
You got it, Dominic? Go ahead.
Yeah, I think with the performance of the stocks and being, since we're picking stocks, that you hear the term diversitize your portfolio. I think most of those stocks are underperforming. Therefore, it's not a good mutual fund.
Exactly right.
You hit it. And if you were live in person, you would be getting a chocolate bar handed to you on your way. Correct. Thank you. Thank you for sharing. Poor performance. That's the reason why they close funds. And a lot of times in your 401k or in a mutual fund family, you'll see what they'll do is they'll get a letter and we're merging this fund into this fund, or we're closing this fund, put your money here. And so, yes, it's usually due to bad performance. And what people don't realize is when they merge a fund with another fund, they close a fund, and then they put out numbers of the funds in the future, they no longer have to count that negative data, right? So remember what we're talking about. Is stock picking, does it add value? And is it a skill that can be predictable? And can someone do it for you to enhance returns? On a more micro level, here's two common fund families that we see. JP Morgan, we see a lot in 401ks, and then I see a lot of American funds and IRAs. So JP Morgan, last time I looked just the other day, has a total of 36 mutual funds, actively managed mutual funds where people are stock picking, broken up US and international. And really interestingly, last time I did this content in another class was 2019, they had 29 in US. So even they closed off and shut down 2 funds due to bad performance. American funds has 21, 8 US and 10 global. So what people don't realize, in American funds, those 8 pretty much are all buying US large stocks. They have 1 or 2 buying small stocks. The other 6 to 7 are all buying large stocks. In JP Morgan, it was 12 out of 27, all buying US large. So sometimes people come into me, Dominic mentioned diversification, and they'll have a portfolio of American funds and say, Keith, look, I'm diversified. I got 5 funds. But when you look inside, go on even on the Morningstar, look at the top 10 holdings, look at their approach, they're all buying US large and they're all buying the same stuff, right? Using the law of large numbers. And the granddaddy of them all, Fidelity Funds, has 386 teams of professionals stock picking doing the same thing. So the bottom line is this, right? I showed you how many new funds are being added every year, how many funds are being closed every year, and this is just that one universe of the professionals doing it for a living. If stock picking really was a skill that people that have all this information can pick stocks that are better than other stocks and beat market rates of return, and you had the best stock picker, how many funds would these companies need? Anybody want to venture a guess on that one? Or put it in the chat? If not, I'll tell you if you haven't thought about it, right? One. They need one. Now you might have one person doing US, one person doing international. You know, and I'm a sports fan, so I would say, you know, if you have Mahomes or Lamar Jackson as your quarterback, in the olden day, you know, I used to say Peyton Manning, you're not drafting 20 new quarterbacks every year, and you're not playing all 20 of them every game day, right? If you got the best, you play the best. So if they had the best stock picker, really was a skill that could be done consistently and predictably, these fund families wouldn't be playing this game of law of large numbers. And what would they call it? What would they call this one fund? I was like, you know, I know in this Zoom world, it's hard to get people to engage. If you want to throw some ideas in the chat box, it's always fun to see what people think they would call this one fund. What we would call it, if it existed, would be the really, really good fund. So again, they're using the law of large numbers. All right, let's see if we got someone in the chat kind of made a comment. Let's see what their idea was. Oh, there you go, super fun. That was, yeah, Leo likes super fun. Go on, Leo, thanks. And then so what they do and what they use is also what we call anecdotal evidence, right? So I'm starting to show you a little bit, is this really a fact or is it a myth? But they use anecdotal evidence. And what is anecdotal evidence? Anecdotal evidence is evidence that is not real but is taken as truth. So, for an example, lottery. Now let's say I was super generous today, and I was going to give everybody $1 million, and I gave you a choice. You can put that $1 million in the S&P 500, the top 500 U.S. stocks, or even take the $1 million and even have a broader diversification of stocks, you know, globally, you know, thousands of stocks, or buy 1 million lottery tickets. What would you do with that $1 million? Buy the lottery tickets or diversify a portfolio of stocks? And again, I'm going to keep going for some, anybody want to chime in? What would you do with the $1 million I just gave you? All right, we got a shy group today. Most people in the class will say, well, of course I'll put it in the stock market. And I say, why? And the reason is, well, if I buy 1 million lottery tickets, I'm still probably going to lose all my money. We got someone in here. Buy Tesla stock. Cool. Thank you. Thank you for participating, Bernadette. Appreciate it. Most people say they would put in the market because they know if they buy 1 million lottery tickets, they're still going to probably lose all the money, right? Yet we see this person, right? Someone's always winning the lottery, but it doesn't change the odds. The statistics are the same. And the same thing with stock picking. Just because you see the winners, it doesn't change the odds, right? But the anecdotal evidence is there. So how does the industry use this concept? This way, right? Law of large numbers, so they always can say, look, here we go, standout funds, or against all odds, they did it, okay? Not realizing that every time they print the same article or something else, it's a different person who beat the odds, a different person that was standout. And then here's another way, right? The 5-star stuff. I'm going to cycle back this a little bit later on in the discussion, right? You know, they show you which one of their funds are 5 stars. It's anecdotal. It doesn't change what we're teaching you that stock picking statistically don't beat their benchmarks. And it doesn't add value. In theory, it's a myth, right? So here's the numbers, right? And this is proven time and time again. And a lot of times if you follow us on social media, every time you see another, you know, study on this, we put it out there because it's always pretty much the same answer. On average, 40 to 60% of active managers don't beat their benchmark every year, right? So I don't know about your profession, but we all have something we measure our success or failure to. Well, in the stock picking world, the benchmark is the index, right? The S&P 500 or the Russell 2000 or the EFA index. And we're going to show you later how to use that instead of the stock pickers. Right? Because the stats are this. 40 to 60% of these managers don't even beat that benchmark. And the ones that do, don't repeat. And that's why, so if you're using active managers, you're most likely underperforming and cheating, even when you're doing well, cheating yourself out of return, because statistically, like any gambling, the house always wins. And these managers over time statistically underperform the benchmarks. So hopefully we started showing you that stock picking is not really a fact. It is in effect a myth. All right. And again, if you have any questions throughout, just raise your hand or put it in the chat, and then we'll definitely address them. So myth number 2, market timing. Market timing is an attempt to get in and out of the market based on how you or someone else thinks is what's going to happen, right? So, you know, Keith, if so-and-so wins the election, I'm getting out of the market. Or I'm going to get out of the market now because I think so-and-so is going to win or lose the election. Or, you know what, I don't like international stocks right now. I'm going to go to the US, or vice versa. Or I'm going to get out of the market and go to cash, and then cash back to the stocks. That's market timing. So again, either you're doing it, your advisors are doing it, or again, most commonly in these products. And the myth is, again, that people can do it effectively. They can guess it effectively and therefore maximize your returns and, you know, all be, you know, lollipops and gumdrops, right? Well, again, let's look at, is this a fact, truth, or is it in fact a myth? So here is, and again, I keep saying it every time we do these classes, every time the numbers get updated, it's always the same story. Here's another time period, the last 20 years, 5,000 trading days. If you had invested $10,000 in the S&P 500, was the top 500 US large stocks, and left it alone, it would have grown to $31,000. But let's say you or your advisor, I see advisors market time, you know, after the 08 crash, I see advisors taking their clients' money and putting it in cash. Even after COVID, people wanted a market time, get out of the market and go to cash. The problem is this, is when markets recover or markets deliver returns, they come fast and furious in short, and generally in very short windows. So if you or your advisor or your product got out of the market because of volatility or for other reason, and you missed just the 5 best days, in this case in the S&P 500 returns, you would have parlayed your 31,000 into 19. But again, here's the other bigger problem. If you or your advisor or someone was nervous and you went from stocks to cash or stocks to bonds, or you changed categories and you were market timing, let's use COVID as an example. The markets tanked in March because of COVID and the lockdowns. Well, were you feeling any better in April? Probably not. So you were waiting. And by the end of April, all the losses of March were back. So you missed the best 30 days of trading. You would have parlayed your 31,000 into less than 6. Market timing is very risky and statistically hurts investors and cheats you out of returns, and sometimes significantly. But then I also hear from people, but back those experts, won't they save me from the downside? Won't they take away the pain of on paper volatility like during COVID or the 08 crash? Okay, that's possible, and sometimes that generally is true. Doesn't mean that is the right thing to do, and I'll show you why. Let's look at the 08 crash. So if anyone in the class doesn't know what happened in 2008, 2008 was the debt bubble burst, the housing crisis, the markets crashed, the economy went into recession. It was not very pretty. And so if you were lucky enough, and that ended in 08, if you were lucky enough to be what we have here, one of the top 30 actively managed funds buying US stocks, you could be, in your mindset, feel like, yeah, market timing works because they did save you from loss. You ended up with a positive return because they market timed out and didn't absorb all the losses. And if you compare them to their peers, that's right here, the peers lost -2. Here's the S&P, which is the top 500 US stocks. And then for the people who know me, you'll start seeing this CRISP a lot. All right, CRISP is every stock is a number 1 to 10. Your large companies, your US large that are 10 billion and larger in size, are 1s and 2s. Your micro caps, your small caps, which are your smaller stocks, are your 9s and 10s. So when you see a CRISP 1 to 10, that's a broad market from small to large. So again, if you think that market timing might save you from the downside, but again, we're talking about is it an effective way to invest. And the problem with market timing is this: you got to be right at least twice. When to get out, when to get in. So here we go back to the professionals. Are they saving you from the pain? Do you think they repeated? They didn't. They missed out on the recovery. All right. So again, market timing is risky because even the professionals missed out on, they underperformed their peers, underperformed the S&P and the market as a whole, right? Because you have to be right twice, when to get out, when to get in. Market timing, again, is very risky. It does not add value and statistically hurts investor returns. So, myth number 3. I know I just beat down myth number 1, and I did myth number 2, but I still know what some people in this room are thinking. But aren't there people out there, again, you know, I showed you there isn't, but we still believe and think there is. And so how do we find these people, that ones that did beat the market or we think are the best? And early in my career, I did this. I used to build portfolios, have diversified asset allocation, and then I would pick managers in each category. And I realized I was doing this also. I was track record investing. So track record investing is finding people in the past that did well and thinking it's a reliable way, a method of indicating how it'll do in the future. And it just isn't. So let's take a look at where's the evidence. Is that true? So back to this, look at a 10-year period. Now we're going to go to common. We're going to go to 2019. So here you go again, top 30, peers, S&P, and then that crisp 1 to 10, which is just small all the way to large, right? They blew away everybody. So here we are, 2010, 2011. Which funds, which managers do you think advisors that were selling these funds or selling mutual funds were selling? Which funds do you think you saw in the newspaper magazine as your 5-star fund? Which funds are being pushed? These, right? Because track record investing tells us, supposedly, that therefore they will repeat. So let's see if that's true. Following 10 years, they did not, right? So here you go again. They did 6. They significantly underperformed their peers. They underperformed the S&P. And then again, when you add the small caps, they underperform the broad market as a whole. So keep in mind, we're talking about track record investing is looking how someone did in the past, a reliable way, and an indicator of how they will do in the future. And we're showing you here the answer is no. And every time this is updated, every 10-year cycle, it's the same story, okay? But I've had people say, yeah, but Keith, when you average these two together, still good. Well, that might be true. Think about what track record investing is. You are choosing your fund based on past performance. You're being sold a fund based on past performance. So therefore, you're getting in, you're buying it based on this, but you didn't get that. You got this. And then you underperformed, right? Hope that makes sense to people. If not, again, just raise your hand and let us know, and we'll address it for you. And then here you go, you got a 5-year period, make a little bit shorter window. This time, they really didn't, the top 30, again, the top 30 best didn't beat they beat their peers a little bit. They barely beat the S&P. So all that extra risk for barely any extra return. And then again, if you added the small caps correctly, they didn't beat the broad market as a whole. All right, but if you bought these based on track record investing, thinking they would repeat, they did not repeat. They did not beat any of the other groups. All right, so hopefully we showed you here that track record investing really is not an effective way to invest, and in fact, it really is a myth. And back to those stats, 40 to 60% of managers don't beat their benchmark on an average basis, and the ones that do not repeat. Right? And that's because they're stock picking, market timing, and all the things that we keep talking about. So again, if you're using these managers and these products, you're most likely underperforming yourself. So far, what have we talked about? We talked about the myths to avoid. At any level, do not stock pick, do not market time, and do not track record invest. So what we're hopefully starting to do, and yes, we will get to how do you invest academically, prudently, and avoid these behaviors. So hopefully through these classes, your antennas start going up, right? And you're able to identify these. And if you're not feeling good, if you're feeling fearful, or you're feeling greedy, whatever the word is, and you call us, you look at our social media, we'll say to you, all right, which behavior are you talking about? And it always comes back down to either you or someone else is stock picking, market timing, or track record investing. And we also like to call that chasing performance. So far, we are teaching you avoid these behaviors.
We got a question, Keith.
Go ahead.
Is there a standard period of years that funds must report as their track record?
No, I see, if I understand you correctly, I see mutual funds report 1 year. The average, I see 1 year, 3 year, 5 year, and 10 years. And then inception is what I usually see customarily, but I don't think there's any regulation or rule that mandates what they do. But one of the games that people will play is they will, use different time frames to manipulate their returns and their numbers as well.
Yep.
Okay, but thank you. Great question. And if I didn't answer that, let Leo know and I'll get back to it. So how does the industry create this illusion that we keep talking about, right? That these activities are work? Well, the media, again, back to it's overwhelming and confusing. It really is. And here's what I mean by that. Now, I know I kind of laugh when I have this one in here, but I still go to the food store and I see the racks of magazines. So there are people still buying magazines. So here's just an example. If you bought every magazine about money off the shelf, you'd have to read about 1,700 pages. If you Google search the word money, you get about 7 billion pages. Take you about 40,000 years to read it all. If you Google search the word investing, take you about 3 billion pages. It take you 18,000 years to read it all. Right? So just right there alone, there's tons of data. And a lot of it is geared towards what we're talking about, and we're going to teach you how to identify it. So for example, stock picking examples, right? I always get this one, Keith, and I love Bernadette, and I'm not sure that, but she mentioned Tesla, right? How can we find the next Tesla? How can we find the next Google? We all want to, hit that lottery, and that's stock picking, right? Or we see this all the time, 12 best stocks to buy now. And then we had examples of market timing. You just buy my book and you can have all this gold. Look at this beautiful gold around you, bags of money. It's easy, lounge in your chair, just market time, right? Then we got, sell stock now, market timing. And then really, interestingly enough, right here is track record investing, right? Oh, let me open up and see which funds are the best. Oh, this fund beat my fund. And then you chase it, or the advisor chases it, right? Stock picking and market timing. Solid stocks to buy now, right? That's stock picking. Then here we have market timing, 8 trends moving the market, or stock pick and stock pick. So here's trends, market time or chase, and then here's 10 best stocks to buy, stock picking, market timing, right? Then you do a Google search stock market, right? Again, hopefully we're starting to put the antennas up, and again, we'll cycle back to how you solve this problem, right? Stock picking. We call this one, again, I mentioned it, I know I was saying chasing. It could be also track record investing. Those words are synonymous sometimes, but also the fear of missing out, right? You get, oh, I should have bought Bitcoin, or darn it, I should have more money in this category. And then you don't want to miss out, so you chase it, right? Stock market's rallying. I should have had more in the stock market, right? So the fear of missing out. And here you go. Second page, well, not second page, but the bottom of the first page. Excuse me, right? Stock picking. This one is chasing performance, market timing. Here's a fear one, and market timing, right? So market timing could be greed or fear, right? Stock picking, market timing. So hopefully we're helping you identify these activities and what you're really reading, and they're designed to kind of, unfortunately, helps people fall off the wagon, we call it, right? And then we have the TV people, the talking heads, all right? We're not going to show you all the videos, but 98% of all this consumption on these channels, it's always stock picking, market timing, or track record investing. Things that do not add value that we're showing you statistically will result in you underperforming. And ironically, this guy right here had a fund, he used to be a fund manager at AIM, and he has one of the dead funds because of poor performance. And then finally, I thought this was interesting. So when I was updating the slide earlier about JP Morgan and how many funds they had, so let's say you had JP Morgan in your 401k, or your advisor was showing it to you, or you're doing your own due diligence. So I went on there just to update my numbers, and I searched how many US funds do they have, and here's where I got the 27, okay? But what was interesting here is I could have chosen 4 or 5-star funds. Well, why wouldn't I, right? So I did. I clicked, well, show me the best. And now we've got 12. So that means 15 of their funds. So a 4 or 5-star rated fund, what it means is, based on their peer group, they were a top quartile. Interestingly enough, it doesn't mean they beat the index, but it just means that they, in their peer group, they were a 4 or 5-star. Okay, so out of the 27, 12 of them were 4 or 5-star funds. The other 15 were not. So 2 things here. A, why are they keeping those other 15 people on the payroll, right? Because they know what I'm teaching, that the people who are the 4 or 5-star funds this year statistically aren't going to beat it down the road, and they need more people doing the same thing, so they always have 4 or 5-star funds. So that's the first thing it's doing, law of large numbers. The second thing is, if you're using this tool, you're track record investing, because like everybody else, of course you're going to click 4 or 5 stars, and that's the ones you're going to pick. All right. So again, this is what the industry is doing, and this is how they're operating. So the bottom line is this: the media overwhelms and confuses. There's just so much out there. They're not really, their job is not to help you be a prudent investor. And they're never held accountable. If you take their advice, or you buy the 10 stocks you read about, or you get in and out of the market based on what they're saying, and they're wrong, doesn't affect them, but it really could affect you. No accountability. They're not there to help. Again, in conservation of time, I'll answer this one myself, because you all kind of probably know it. What are they there to do? Sell advertising. That's it. Click on the link, buy the magazine, watch our TV. We're human, so they have to do that to get you to watch and consume so they can sell more advertising. That's their purpose, plain and simple. Okay? Awesome. Any questions so far? Doing good?
We've got one out there, Keith, that I think is worth giving a response to. So if somebody was to invest entirely in emerging markets, how would that fit into one of these myths?
If someone was to invest entirely in emerging markets, how would it fit into these myths? Well, it depends. If you're doing it because you think that's a good place to go because it's going to deliver better returns, then you could be chasing performance. So that's one way. Now, well, I'll show you, like in our portfolios, we have emerging markets, right? So there's an academic portfolio construction that would say, here's how much in emerging markets you should have if you're aggressive, growth, moderate, or conservative. So that's when you would add it. If you're going 100% emerging markets because that's the place to be, again, that's market timing. But if you in your portfolio, if you buy a passive emerging market fund that has every stock, then at least you eliminate the stock picking. You're not trying to pick the best stocks in that category. So there's multiple ways. So,
and then there's a diversification problem if you're only investing in emerging markets.
correct. Yep, for sure. And that's a very risky category, for sure.
Yep.
Which does deliver returns, and you want to have it in your portfolio. But so hopefully we answered that question. If not, please let Leo know, and we'll get back to it. Okay. Thank you. Thank you for that. It's good question. So now that I told you what not to do, how do you build a better portfolio? How do you have an experience that creates peace of mind around what you're doing and why? All right, so let's explore that. The first thing that we're doing here is you have a choice to be made. So I'm going to get to portfolio construction in a second, but I am probably the first or very few people who has ever told you there are two approaches to investing. One is stock picking and market timing and track record investing. The other is no stock picking, no market timing, and track record investing. Most people don't tell you that because the industry business model is active, right? So they tell you that these managers are really gambling and speculating with your money, then they're out of business. And then depending on where you fall, if you believe in this, then you have to eliminate this throughout your behaviors by you, by your advisors, and in the products that you use. And really identify it if someone's talking about that. And if not, that's when you call me and I say, which myth are you referring to? What are you asking me to do? Or what are you asking yourself to do? Okay, so if you believe that stock picking and market timing and track record investing does not add value and is speculating and gambling and can lead to you cheating yourself out of returns in your 401k and IRA, then you have to be true to that. And the way that you do that is that you don't use active funds and you don't use advisors that engage in activity and you don't do it yourself. So I'm going to show you how to build a portfolio of many asset classes and you don't market time there, and then you use index-based or market-based products, right? So you in your 401ks over the years, I'm seeing more and more indexes finally being added. I still think they're lacking on the categories that are being made available, but for an example, almost every 401k now has an S&P 500 index fund. So if you believe in no stock picking and no market timing, then you own the S&P 500 index fund in your 401k and not the Fidelity Contra fund or not the Fidelity Growth Fund. If you believe that stock picking and market timing are dysfunctional and don't add value in your 401k, if they have an international, it's called the EFA index, you own that instead of the American Fund, Euro Pacific Fund. Okay? So you have to align your strategy with your belief. That's the number one thing you have to do. All right? Hopefully that made sense. Right? So for example, for the visual people, I showed you earlier how to identify active management. Right? And again, you can go on Morningstar and get that information. If you need any help, again, we have a passion to serve and help. We're not going to charge you a fee to help you find this information. Just shoot us an email or give us a call. Right? So here's active management, stock picking, no stock picking. The S&P index, 500 funds. So here's a small cap index or small cap market fund. And then here's an international. So these are available, right? For do-it-yourself, ironically, DFA used to only sell to advisors. And people like me like that. DFA just actually finally launched retail ETFs that you can get these products on your own. Or you get them through a person that shares this market belief, right? Or you can go to Vanguard and get all these categories in the Vanguard on your own, right? Or in your 401k, look for the index. Look for the market fund. If it's there, and if not, tell them that you want it. So you can see the difference. That you will see some turnover in a market fund. The only difference is the only turnover in a market fund is not because they think it's good or bad stock, just because a small company might grow to be a mid cap or a large cap, so they have to get it out, right? In the S&P, they're adding or taking out funds. And so the only time you see turnover in an index fund is if the stock no longer fits the category. So you can see here, I'm trying to show you and visually illustrate the difference between active management and index funds. Another thing too about the first thing, the three powerful things, you think you're diversified and you're really not. What's diversified? People think, oh, 145, that's pretty diversified. Yeah, it is, but not when there's 2,000 in the category. And statistically, I've already shown you that most likely this manager is not going to beat the benchmark. So again, why are we engaged in activity where statistically you're going to cheat yourself out of returns? Right? So what's most important is, and you hear it, and this is where the industry says it a little bit, but then they fail at implementation. It's all about asset allocation. That's the drive. This has been proven. Nobel Prize economics winners. The drivers of return do not come from the stock picking and the market timing, which usually leads to negative returns, or not negative, but underperformance to the benchmarks. The drivers are the asset allocation, and are you doing that correctly? And then eliminating the stock picking and the market timing and the track record investing. So what does that look like, right? I'm going to skip this one. I like this one better. So what does asset allocation look like? Asset allocation looks like this. So this is showing you 9 different categories. When I say categories, I mean large as a category, small as a category, U.S. large, U.S. small, international large, international small, U.S. emerging markets small. So here's just an example of 9 categories, and the best performing category and the worst, the last 30 plus years. And each has a color. And if you really analyze this correctly, you will notice what's ever on the worst always ends up on the best, and what's on the best always ends up on the worst. There's no rhyme or reason. So what does the market timer try to do? They try to guess what will be the best going forward, and statistically they're getting it wrong. What proper investing, academic fundamental investing is, you own all the categories. So you're always going to have categories doing poorly, and you're always going to have categories doing well, because no one knows the future, right? And we'll show you how you take advantage of this dissimilar price movements, all right? For proper allocations, you own them all. And then we see the pie charts. We've all seen these kind of pie charts before. These are all academic-based, fundamental. So that person said before about owning emerging markets. Yes, 100% emerging markets is not diversification, but all these portfolios have emerging markets in it. The difference is you would, as an investor, you build or you choose an allocation based on, are you aggressive, down to conservative. All the categories in any of these pie charts are always the same. The only difference is, as you go down the scale, 95% in stock versus 25% in stock. The same categories, just lower percentages based on how aggressive, based on your time horizon, which allocation is appropriate for you and what you're trying to do. All right, that makes sense? And then also what you want to do is once you have the right allocation, you want to rebalance, right? So for an example, I just use this, the growth allocation, as an example. This one has 34% in U.S. large. So this happens, let's say U.S. large on a great run, and now it's worth 50% of the portfolio. The foolish investor would, when we see this, will say, darn it, I should have more of that. And then they sell this stuff. They get the 401k statement, their track record investing, and say, darn it, I should have had more here. And then they sell it and they do this. And what they're ended up doing is they're violating rule number 1 of investing. They're selling low and they're buying high. And then the following year, it flips. That's not what you do. What you do is, again, you choose the right allocation. And then when it's out of balance, you get back to the intended targets. So you rebalance, and now you're back to the 34. So you always, by default, are always selling what's doing well and buying what's doing bad, because if you diversify properly, you always have categories that are underperforming, because that's just the way everything behaves differently. Rebalancing will actually keep your allocation consistent, reduce volatility, and on average, add an additional 1 or 2% return. Okay, and studies have shown that. Now, it's emotionally difficult to rebalance, right? Because you're selling things that feel good and you're buying things that in a window that have underperformed. So in your 401ks, a lot of plans now, they'll have a feature that you can check off, rebalance automatically, and then sometimes you can choose annually or quarterly, so it does it for you automatically. In our portfolios, same thing. Our portfolios, the vendors that we use, we choose the allocation, and then every quarter, it automatically rebalances, okay? And if it doesn't, if you don't have automatic rebalancing, I have clients that they don't in the 401k. Yes, we just have a spreadsheet, have all the categories, all the index funds, hopefully, that we can use. If not, we try to find active funds that have the most holdings and least amount of buying and selling. And then we'll get on a meeting and I'll put the numbers in the spreadsheet. And if it's out of variance more than 5%, we'll get the numbers that they'll have to go in and rebalance. So that's rebalancing. So that's investing. So the bottom line is this. Investing comes from what I'm starting to teach you here. It's the right allocation, owning all the categories, and then choosing the portfolio based on your risk tolerance and time for when you need it. And then in each category, you eliminate the stock picking and the market timing, and you don't track record invest, and the best that you can, you take a market approach in all the categories where you own thousands of stocks, not hundreds. All right? And here's jokingly the problem. I had a client in an education class said this. He said, Keith, man, I get it. I love what you're doing, but this is boring. It makes sense. It's not exciting. It's not sexy, but it makes sense because what we're teaching. It's not investing in it because what happens is we like to have a sense of control and we want to feel like we're doing something. And it gets exciting. You know, gambling is exciting or speculating is exciting. And if you're not going to do it, someone else will do it for you. But investing shouldn't be exciting and sexy. This is fundamental, basic academic investing. This is how you do it. Leo, I saw a couple questions in there. Anything that fits what we're talking about right now? I'm going to keep going because I want to try to stick to our time here.
Yeah, let's keep going.
Okay. So, you know, a lot of times what happens when I teach these classes, and back to that more detail, too much detail or not enough detail. I know people want to see, all right, Keith, well, if I take a market approach and asset allocation and eliminate the stock picking and market time and track record investing, you know, I know you're showing me, I typically will do better, but show me the numbers, all right? So for those in the room who want to see the numbers, so here you go. All right, here's again, multiple categories. So here's different categories, large, small, international, small. Here's your 1-year return through 19. Here's your 10-year return. Back to that person, you're right. I could do 10-year from to ending in 19, ending in 18, ending in 17. The difference with us is every time we do these updates, it's always the same positive story. But if you want to see it by different time frames, you have to come see me, or, you know, not you have to come see me, but we can provide it for you. Okay. And I even had 5 years in the past, but we got that too much information stuff. So we took some out. But you can see just by the categories alone, the returns are there. And they're pretty good. Now here, this is your safe money. I have it there for comparison. So of course, it's a lower than stock market returns, but that's okay. And that's with no stock picking, no market timing. So don't cheat yourself. Why are we engaging those other activities to beat returns that are already pretty good to begin with? All right. And then back to those portfolios. You know, again, I can show you a 5-year if you want to see it. And every time you update it, it's similar, same numbers. The aggressive, 25, growth, 21, and then down the scale, get more conservative. You expect lower returns, which is fine. If anyone in here that knows what standard deviation is, the higher this number, the more volatile. And so, you know, as you go down the scale, less volatility. So another thing too, I kind of skipped ahead before, is I do have clients that sometimes will have multiple buckets, right? Even my retiree clients, we might have a lot of money here, but we'll have some maybe here because they hope to live, you know, we need some money for growth. Whereas with my son's college money, I had 100% here And by the time he's getting closer to college, I had moved it down the scale. By the time he was going to college, I had 100% in safe cash and fixed income. Even if I thought the market was going to do great, sometimes you'll have different buckets based on the purpose of your bucket. If your time horizon is shorter, you can't afford as much of the window volatility, okay? And again, no stock picking, no market timing. So again, don't cheat yourself. Even Warren Buffett, that people will say is the best stock picker ever, even he will tell you what we're teaching. And at the end of the day, he's not talking about diversification broadly against categories, but just as far as the U.S. market is concerned, you're better off just buying the S&P because you'll actually will probably beat the experts in the long run. And he's included as one of the experts. All right? So at the end of the day, the people that do the stock pick in the market time, the professionals, know what we're teaching to be true. All right? So how to proceed? Let's summarize it and wrap this up for you all. Eliminate the gambling by you, your advisors. Again, I see advisors during 08 went to cash. I've seen advisors before the election. Client calls them up, says, Keith, they're like, not me, I don't do it. But they move their clients to cash because the client says, I want out of the market because I think so-and-so is going to win. And believe it or not, people felt that way on both sides of the aisle, right? And so facilitator says, sure, they don't want to lose the client. You call me, I'm going to say, no, what are you asking me to do? You're asking me to market time, and we're not going to do that. It's dysfunctional and it hurts you. So eliminate it. You don't do it. Don't hire people that do it. And especially don't use products that do it. Okay, and we started showing you how to find products. God, I can't draw a line with this. It's hard, right? Focus on where returns come from, which is the asset allocation. All right, proper diversification. And then, yes, as you get older, it's appropriate. I have a client the other day, he said to me, Keith, he was nervous about the market. And I remind him, we've been shifting your allocation down for the past 3 years because you're retiring in 8 years. We've already been putting money in safe fixed income. Oh, yeah, I forgot. So, again, that's an important part. That's not market timing. That's just shifting because your time horizon is getting shorter. And then ignore the media, turn it off, and remain disciplined over a lifetime. And yes, we know that is hard to do. And that's why if you're ever feeling anxious or you're not feeling comfortable or you just want to talk through things, give us a call, check us out on social media. During all these times, we send out articles and we do, we comment on what's going on and we always get it back to these lessons. All right. But yes, we know being disciplined is not easy. And that's why sometimes it takes someone like me and Leo to kind of talk you off the ledge. So to kind of finalize this and wrap this up for you all, sometimes I have people in the room, so hopefully the other thing helped you. Sometimes I have people in the class that say, Keith, man, we love what you're doing, and why do you do this? And how do you fit in? How does Family Wealth Partners fit into this? So if I could just take 1 minute and kind of share that with you. The first way that we help people is doing this, ongoing investor education. Whether you're a client or not, we feel that everyone's entitled to great advice, and if it helps people and you're not a client and you take this and you implement it in your 401k, 6 degrees of separation, it helps everybody, right? So it helps the economy, it helps everybody. And so we believe strongly in good education and to combat what you're coming across and all that media, financial pornography, we call it. But the second way is for the people who don't want to do it yourself. If you want us to help you with your IRA, your 401ks, or your college fund, your investments, yes, we are fee-based advisors. We have platforms that we use that implement, proper allocation, proper diversification, no stock picking, no market timing, automatic rebalancing. We can help you do it in your 401k. We're very competitive. If we're doing a good job, then you'll be a client for life, and then you'll become raving fans. So if you want assistance implementing any of this stuff, yes, as a firm, we do make a living that way, and that's on the second way we help people. And then the third way that Leo said earlier, we do a lot of financial planning for people. So how does this all fit into really, your 401k statement is not what you're doing this for, right? You're doing it for something else. maybe buy another house or put your kids through college or retire or, travel more if we ever could travel again. Or you can travel again, but traveling away where you might be less at risk kind of stuff. But, that's really, another way we help people is financial planning. How does this fit into your retirement plan? How can we help you, cash flow plan? How do we help you get rid of debt? All that kind of stuff. So that's another way that people do engage with us. And so this is how we fit in. And what Leo's going to do in the chat, if anybody wants to just kind of meet with us over the phone, and we are doing face-to-face meetings. We will social distance. Wear a mask in here if you want us to. We have a long table. We're more than happy to do face-to-face. But Leo's going to put this in the chat. If you want to help with any of these topics or anything we talked about today, just click on that link, fill out that form, and someone from the office will reach out to you, and we'll talk. And we even do a meeting on the phone and use Zoom to do it. So that is the end. I appreciate we did go a little bit over. For those that me, I like to chat a little bit. So I think we did a good job sticking to time. We do have some questions. So me and Leo are going to hang around. But if anyone, of course, you're always free to leave. So we're going to address the questions now that we have. And for the rest of you, I want to either definitely stay. You're welcome to stay. Thank you for participating. We hope you found this valuable. And we look forward to seeing you at other online events. And if you haven't followed us on social media, on Facebook and Twitter, please go ahead and do so. So excellent. Thank you. Thank you very much.
Thanks, everybody. Yeah, and as Keith was saying and showing in that strategy session, that other area has been used by people for any number of things. We know timing is everything when it comes to personal finance. So we meet with folks who are shopping for mortgages, or this time of year, they're trying to figure out what their best health insurance is or get their taxes together. So that other area, if you have things going on that you want to bounce off a professional, those are the things that, we are available to work with our clients on, and we can consult with you about.
Yep, for sure. Especially now with open enrollment going on with health insurance, I get that question a lot. So we're not health insurance professionals, but I do it enough. I know it very well, and I'm a consumer of it myself. So, whether on the HSA or PPO is better for you or that kind of stuff, we're available. So, does anybody have any questions before we're wrapping this up or closing down here? So, any final questions before we conclude this event? All right. Well, thank you again, everybody, for participating. It's been a pleasure. And we hope to see you guys again soon. And feel free to reach out to us, and have a great rest of the night. Thank you.
Hey, Keith, I think we have one, actually.
All right, go ahead.
Yeah. And actually, we'll keep this one for a follow-up one-on-one. Sorry about that.
Okay. Excellent. Well, I got a thumbs up from Karen there. Thank you, Karen. We appreciate it. So I'm still adjusting to this. I love the Zoom. I think this is great. I still find it difficult that I can't see people as much that I like. But again, it's a pleasure. And thank everybody again for participating. We hope to see you again soon. Have a great rest of the night. Thank you.
Thanks, everybody.
All right, how do I open this?